Okay, let's unpack this. Today, we're diving into a really fascinating area of corporate finance, one that can create significant value. We're talking about how companies can optimize and, well, essentially transfer the economic benefit of their research and development, their R&D tax credits to their partners. You've shared some great sources detailing how this can be done. So, our mission in this deep dive to pull out the most important nuggets, the key facts, maybe even some surprising bits about making these valuable credits work for partners, even when, they seem like they can't be transferred. It's all about finding those lawful pathways to share the financial strength.
Right. And what's really powerful here, I think, is seeing how a company, once it's, built up some financial credibility, maybe with the IRS, with banks, and is actively doing R&D, it can then start exploring these more sophisticated strategies. Things like this can seriously enhance its financial position and its strategic leverage, too. It's about being smart with assets you're already generating.
Okay, so here's where it gets really interesting, right? Because when you first look at R&D credits, they seem pretty locked down. Our sources definitely confirm that, generally speaking, these R&D credits are non-transferable. Federal law, specifically 26 U.S.C. Section 41, it doesn't have some clear clause saying, go ahead, transfer this to an unrelated party.
That's right. The default is clear.
The credits have to be claimed by the taxpayer who actually incurred the qualified research expenses. So yeah, that sounds like a pretty big roadblock. What's the clever way around this? Is it a loophole or something else?
That's a great question, and it really gets to the heart of it, is where the nuance lies. You're right, you can't just assign the credit directly. It's not like handing over a contract.
Yeah.
But the key is understanding that while direct assignment isn't really on the table, there are several perfectly lawful and strategic ways to effectively pass through or monetize the value of these credits to partners.
Ah, okay. So it's about the value, not the credit itself moving directly.
In some cases, yes. Or it's about the structure allowing the credit itself to flow through channels that are permitted. It really hinges on how the company is set up and how it interacts legally and financially with its partners.
Right. So if you're listening and thinking, okay, how can my company start sharing this R&D benefit? Our sources point to maybe the most, let's say, elegant and direct solution first. And that often comes down to how your company is already structured, maybe like a high-growth tech startup, innovating like crazy, but set up as a partnership.
Exactly. If your company is a pass-through entity, think a partnership or an S corporation. These are structures where the company itself doesn't pay income tax. Instead, profits, losses, deductions, and yes, even tax credits are passed through directly to the owners.
To report on their own returns.
Precisely. This structure itself opens up a really clear pathway. Under specific IRS rules, Section 704B and 1366, these entities can allocate tax attributes, including those Section 41 R&D credits, directly to their partners or shareholders. It's based on their distributive share. Think of it like a transparent pipeline. The credit flows through the company to the partners.
Okay, so that sounds like the most direct route. What does that actually look like in practice? What are the steps a company needs to take?
It's actually quite methodical, step by step. First, obviously, confirm the company is taxed as a partnership or S corp. That's foundational. Second, and this is really crucial, you've got to update the company's operating agreement, or the shareholder agreement if it's an S corp.
Okay.
Needs an explicit clause. Got to spell out how the R&D credit will be allocated. This allocation, it can follow ownership percentages or it could be custom. But, and this is a big but, it must have what the IRS calls substantial economic effect.
Meaning it has to be real, not just for tax purposes.
Exactly. It has to actually impact the partner's bottom line in a meaningful way, up or down.
Yeah.
And it needs to be properly reflected in their capital accounts, basically, their stake and investment history in the company. Then the mechanics staff files IRS Form 6765 to compute the credit amount. Then you file Form 3800, the General Business Credit Form, and specifically Part 3 lists the partners and their share of the credit. And finally, you issue the Schedule K-1s. Each partner gets one, showing their allocated share. They use that for their individual tax return.
Yeah, and this is all above board, based on established rules.
Absolutely. It's grounded in Section 41F on aggregation, Section 704 on partnership allocations, and the Treasury regs like 1.704-1B, which detail those economic effect tests. It's a well-trodden path, legally speaking.
It's very clear for pastors. But what if the company setup is different, maybe more complex? Say you've got multiple subsidiaries, each doing some R&D, and you want to pool those efforts for credit purposes. That brings us to, I think, another strategy mentioned, using disregarded entities. How does that help?
Yeah, this approach is quite clever. especially for larger or more complex groups. It lets you consolidate R&D activities and the resulting credits. It often involves using entities like a qualified subchapter S subsidiary or Q sub or maybe a single-member LLC. For federal tax purposes, these are effectively ignored, disregarded, and treated just as a division of their parent company.
Okay.
Now, the key tax code provision here is Section 41F1. It basically says that all members of a controlled group of corporations, think of it like a family of businesses under common ownership, are treated as a single taxpayer when calculating the R&D credit.
Ah, so you can aggregate everything.
Precisely. So the strategy looks like this. Maybe you form one or more of these disregarded entities, perhaps housing-specific R&D projects or teams. You pool all the qualified expenses from across these entities under that Section 41F rule. This often generates a larger unified credit than if each did it separately. And then you allocate that credit up to the parent level, often through the consolidated tax return, or maybe via those pass-through K-1s if the structure involves partnerships. It centralizes and potentially maximizes the credit.
Okay, interesting. So we've got direct pass-through and pooling within a corporate group. But what about something more, well, drastic? Like a company being bought or merging with another? You said you can't just assign the credits, but do they just vanish in a merger? Our sources hinted they can survive. How?
Right. This is where things get more complex, but potentially very powerful. It's not assignment, but carryover. Under Section 381C4 of the tax code, which deals with carryovers in corporate acquisitions, general business credits and R&D credits fall into this category, can carry over in certain types of tax-free reorganizations.
Tax-free reorganizations? Like mergers.
Exactly. So if your company merges or consolidates with another entity in a qualifying way, maybe it merges with a company controlled by its existing partners, for example. As part of a larger strategic move, the R&D credits it generated can transfer as part of that whole transaction. They become an asset of the surviving or newly formed company. It's not selling the credit. It's the credit moving along with the business itself.
Wow. Okay. That sounds like a major corporate maneuver, a big chess move. I imagine that's not something you just, decide to do over lunch.
Absolutely not. This strategy requires extremely careful planning and top-notch legal and tax advice. You have to meet strict requirements, like the continuity of business enterprise test, meaning the historical business or assets must continue in the new structure. The whole transaction needs meticulous structuring to comply with Section 368 reorganization rules and Section 381 carryover rules. Definitely for complex situations, high stakes.
Right. Okay, so 3 methods down. Now, the last one sounds different. A clever, indirect way to transfer the value, even if the credit itself stays put, through strategic capital infusion. This almost sounds like, financial alchemy. How does the benefit flow to partners if the credit isn't directly moved or passed through?
Not quite alchemy, but certainly smart financial engineering. And perfectly lawful. Here's how it works. The partners, perhaps seeing the value the company is creating via R&D, decide to invest more capital into the company.
Okay, so fresh cash comes in.
Right. Now, the company, boosted by this R&D activity, generates the tax credit. It then uses that credit on its own tax return to reduce its tax liability, tax saving. It directly increases the company's bottom line.
Yeah.
More profit or less loss. More cash available.
Because it paid less in taxes.
Exactly. Money saved on taxes is cash the company now has. So what can the company do with that extra cash, which is effectively funded by the R&D tax savings? It can issue distributions or dividends back out to its partners.
So the partners put capital in, the company saves tax using the credit, and then distributes that saved cash back to the partners.
You got it. The credit itself never technically left the company's tax return.
Yeah.
But its economic benefit. That flowed directly through to the partners via increased distributions. It's a beautifully indirect but very effective way to share the wealth generated by R&D.
That is clever. Okay, so we've unpacked 4 really distinct ways to make these R&D credits work for partners. We've got the direct pass-through for partnerships and S-Corp.
Right.
Pooling credits using disregarded entities in a controlled group.
Yeah.
The complex carryover through qualifying mergers or acquisitions.
That's a big one.
And this indirect value transfer via capital infusion and distribution. But it sounds like no matter which path you might even think about exploring, there's one constant theme, right? Compliance.
Absolutely paramount. Non-negotiable. You really don't want to get this wrong and face an IRS audit, especially with something as scrutinized as R&D credits.
So how do you stay compliant? How do you, audit-proof these strategies as much as possible?
It boils down to robust contracts and meticulous documentation.
Mm-hmm.
This isn't just paperwork. It's your defense, your proof. You need to first, as we mentioned for pass-throughs, update those operating or shareholder agreements. Explicit clauses on credit allocation, clear substantiation of that economic effect we talked about. Make it crystal clear.
Got it. Spell it out.
Second, meticulous and accurate filing of all the required IRS forms. Form 6765 for the credit calculation itself, Form 3800 for the general business credit and allocation. No room for error there. Third, properly issue those Schedule K-1s to every single partner or shareholder receiving an allocation, clearly detailing their share. Consistency is key. And finally, for an extra layer of protection, particularly with more complex strategies, strongly consider getting a formal legal opinion letter from a qualified tax attorney.
Like a stamp of approval. Sort of. It demonstrates you did your due diligence, sought expert advice, and believe your position is sound based on current law. It can be very valuable in an audit situation. So really, by strategically structuring things, whether it's the entity type or the transaction, and then rigorously following all the IRS rules and documenting everything, a company can lawfully transfer or allow partners to benefit from the economic value of its R&D tax credits. It optimizes the company's finances and definitely boosts its strategic leverage.
Wow, what an incredible deep dive.
Yeah.
Seriously. We started with what looks like a lockdown, non-transferable tax credit.
Yeah.
And we found multiple, completely lawful pathways to actually leverage its value for partners. From pass-through structures, which seem relatively straightforward,
If you fit the mold, yes.
all the way to strategic capital infusions. It really highlights how digging into the nuances of tax law can unlock some significant financial potential.
It absolutely does. And it really raises an important question, maybe for you to think about after this. In what other areas of business, or maybe even personal finance, might there be a rule that seems really restrictive on the surface, but actually has sophisticated compliant workarounds or strategies hidden within it? Strategies that could unlock hidden value or give you a strategic edge. It often comes down not to breaking rules, but understanding them so deeply that you find those legitimate pathways that maybe others overlook.